Okay, so we're here with Akiba Leisman, who's the CEO of Mako, and we chatted with you just on the back of the initial, or a few months, I guess, after the announcement of the intention to acquire Gold Source. It was just at the end of April after you released the production metrics for Q1, and now you've churned out Q1 and Q2, and the acquisition has closed. So why don't you just talk a bit about what has happened since we last spoke with you?
Yeah, I mean, specifically about the acquisition. So we closed on July 3rd. So I think everybody has to take a little bit of a deep breath and kind of understand that we've only owned this asset for less than 3 months. That being said, me and the senior team were down in Georgetown, Guyana, meeting with the various government ministers who are in control of the mining industry over there. And it is a night and day experience. Working with this government versus just about any other jurisdiction that we're involved with. Now, Nicaragua happens to be like a particularly mining friendly jurisdiction as well, but Guyana, for very particular reasons, really do want to advance and rapidly advance their mining industry. So the questions that we get are, how quickly are you going to get this thing into production? Are you ready to go? What are your plans with it? What is the level of employment, especially for areas and districts outside the main capital area? And when we tell them we have the resources to do this, we have the intent to do this, we have the skill set to do this, they're bring it on. So that's basically the attitude that we have from the Guyanese. It's a pretty spectacular country in that regard.
Yeah, I mean that's it's fantastic to hear, and it's the same story from the few players that are actually existing going on in the mining space that are public and haven't been acquired in recent months, I guess. So it's a hot jurisdiction, not too many players, but it sounds like you will have no sort of modern mining issues as you might have in North America with permits. I mean, everything will be expedited in that regard. So there is no roadblocks that are being put up. The question it might be then, do you think that there might be active? I mean, I know in terms of infrastructure, the government is keen to support with road building, access to power, and so on. That's not always an issue, anyways. But do you think there could be other incentives to existing projects that might go into production soon, or that might be debt from a government fund or something like this, or at better rates, anything like this?
All right. So we can come back to the direct investments in a bit, but just the indirect stuff and the infrastructure, just in terms of what's going on with the country. I'm sure your viewers and listeners know that Guyana is turning itself from one of the poorest jurisdictions in the Americas to one of the wealthiest because of the oil find, and they're certainly reinvesting a lot of that in infrastructure. So the nearest term impact to us is that there's a pretty major, I think it's about 120-kilometer road from Linden, the bauxite capital of Guyana, down right by our mine. What would normally take a pretty rough 9-hour car ride would get that cut nearly in half in terms of the transportation from the capital to us. It certainly will make logistics, staffing a lot easier once that's built. And then we also have a project that's particularly attractive to us, which is scalable, right? So the first approach and the first phase of the project is to focus on the easy stuff. So the saprolites, which doesn't require a lot of grinding energy, doesn't require a lot of power to run to get your rock down to size that will allow the gold to be recovered. But once we actually get into the second phase of the project, when we're dealing with the hard rock, that changes, right? So we will need to have power and the ability to transition from running on diesel gensets, which inevitably is going to be part of the first stage of the project, to potentially being either on grid or to find some off-grid but access to power type solutions will be a game changer in terms of the operating costs of the next phase of the project, which luckily enough for us, I actually think is going to kind of dovetail pretty nicely into when we would be making that decision. So we're planning on starting to build the operation in 2026 for first production in 2027. And then the hard rock, as it relates to the PEA that was put out in January, will probably come in 4 years after that. There may be reasons why we may have it a year or so sooner than that, but kind of in the 2031 context, we have a full expectation just because of the revolution, the renaissance that's going into Guyana right now, that the infrastructure in there will be supportive for doing things like that, where we can actually have access to energy sources that are going to be a lot cheaper than running this on a diesel genset basis. So the infrastructure definitely is going to be helpful to the project and the long-term project economics. And then from a direct investment perspective, you're right, is that the Guyana right now has more money than it prudently can put to work. So they are accumulating a sovereign wealth fund. There is going to be a growing financial sector. There's going to be a growing desire to invest in projects that are not affiliated with the hydrocarbon space. So we do think that there's opportunities over there. But I do think more broadly, I guess one of the main differences between Guyana and Nicaragua is that, like I said, Nicaragua is a very mining-friendly jurisdiction. But one thing that is night and day between the two of them is that in Nicaragua, you don't really have great access to external capital. So, for instance, we're a company that generates close to $100 million of revenue. At these gold prices, probably even more than that per annum. You actually look at our balance sheet in terms of what types of facilities that we have with suppliers. We really only have very limited amount of capital. That's not even by design. For a company like ourselves, we would actually have a substantial revolver on our balance sheet just to deal with some of that. But for us, just because of jurisdictional issues, we kind of run the business almost on a cash basis. Guyana is different. So there you'll actually have the ability to attract international financiers, which inevitably will make the capital efficiency of building and operating these projects a lot better than what you would actually see in Nicaragua.
So just to go back to the infrastructure question, so can you just remind everyone, in the PEA, I assume that it's not assumed that you would have grid power once the hard rock mining and processing starts. No. So that's something that might be incorporated into a new study potentially. Is that something that could be done, a scenario?
Yeah, absolutely. And it's not necessarily even grid power, right? I mean, there's talks about having river-based hydro power and things of the sort. So we're going to have a lot of time to investigate what that might be. But I do think the opportunity set to be accessing these things in a country like Guyana are going to be substantive in the timeframes that we're talking about.
Do you have a sense? I mean, this is difficult to say. I would assume it's difficult to say, but do you have a sense of what impact that might have on the cost structure as outlined in the PEA if you would just get a lot more efficient power for the project? What kind of impact?
Yeah. So to put this into context, the net incremental processing cost per ton between the saprolite and the hard rock is probably running you a little over $10 a ton. A good portion of that. Probably don't have the exact numbers right in front of me, but if I had to guess, don't hold me to this, it's about half of that is actually strictly from power. You're probably looking at something along those lines for kind of where you can take bites out of operating cost savings and sensitivities. So from a dollar per ounce perspective, these kind of grades that can be significant.
So we would talk about maybe $3-4 US spend less per ton or something like this, 3, 4, 5.
Right. Exactly. Now we're talking about back of the envelope type calculations over here, but none of those numbers actually sound crazy to me.
Okay, and just to put that into context. For people people who might see this for the first time, but what type of grades are processed per ton once you get into the hard rock, so one can get a sense of the revenue per ton to what the actual cost structure per ton might look like?
Yeah, I mean, it's one of the positives on the geologic features over here is that the hard rock does actually run a little bit higher grade than the saprolites. So the saprolites are running just under a gram. And then the hard rock is probably running you at about 1.2. So you do actually have a grade pickup as well. So you can imagine what kind of cost per ounce that will achieve when you're talking about grades of this magnitude.
And I think it could just be good. Can you just give the Q2 synopsis in terms of performance, what we saw in Q2, your key takeaways for Q2? Yeah,
so Q2 was a particularly good quarter, right? So So one of the things that I always caution people about Mako, you cannot take a quarter of what we do and multiply by 4, right? So this is and this is on the Nicaraguan asset. I do think that there's there are elements of stability and lower volatility for a project like Guyana, but Nicaragua does have a lot of volatility around it in terms of where we are in the mine plan. Actually, it's not even related necessarily to grade variance, right? This actually is our San Albino project in mine in Nicaragua is actually pretty well controlled from a grade distribution perspective. So kind of what you see is what you get. I mean, the veins themselves will grade somewhere in the neighborhood of about 17 grams for these, let's call it 90 centimeter type wide veins, and there'll be a mineralized hanging wall and footwall that will grade anywhere from 0.5 gram to 3 grams on either side of that. So when you're talking about the diluted vein that's coming out of just about anywhere on the project, it's going to run anywhere from 11 to 14 grams. And that's kind of the way that we mine it and the way that we control dilution. That's not where the volatility comes from. Where the volatility comes from is the planning on making sure that we have enough working faces to feed the mill at any given point in time to make sure that our ratio of that diluted vein going into the mills versus kind of the lower grade stockpile material that we have are consistent. Now, where that can kind of go awry is when we actually have access to different working faces, and that can be something as short term as like what we experienced in the last 24 hours. We had like a large rainstorm last night, so we can't really mine at the Southwest Pit for another 48 hours just because we're in rainy season. Imagine that it rains during rainy season. Those are like short term variances that we get for our mine plan. And then there's some things on the longer term side of things where for your listeners who've heard the story before, at the end of 22, I made a decision to bifurcate the permitting over at San Albino into two, mainly to save capital. This was right after the time that sanctions were introduced into the country. There was a little bit of uncertainty as to what was going to happen with the mining industry over in Nicaragua at that point in time. And then we were staring at probably a $5.5 million surface acquisition before we can prudently go and get the entirety of our second mine permitted called Las Conchitas. So we made an arrangement with the government saying, could we only get 7 smaller areas and basically just acquire those $1.8 million worth of surface rights associated with that. And then once we're in cash flow from Las Conchitas, come back, acquire the rest, and then get the full EIA approved. So in 23, we were expecting that bulk sample permit to come in late Q1. Wound up coming in very, very late Q2. So there was probably a good 3.5 month delay in our expectations. I don't think that was a government issue with respect to that. I think that's just normal permitting timelines. But what it did do is it made and this is the year 2023, it made our Q2 and Q3 numbers light. And I got a lot of criticism of the markets. Oh my God, these Mako guys, what are they doing? Like, even though there was a little bit of profitability that quarter, these guys aren't all that profitable. I actually made the announcement in September of 2023 saying, so this is actually before our Q3 financials came out. Guys, we got the permit in June. We're processing Las Conchitas material. We're now operating on all cylinders. And lo and behold, we had blowout numbers in Q4, in Q1, and Q2. Just between those 3 quarters, we generated close to US $40 million in mine cash flow and about US $25 million in net income just for those 3 quarters. Now, during that time, we used some of that cash to go and acquire the rest of the surface rights and then apply for our EIA. I think if we absolutely thread the needle, we were able to acquire those rights. And then we had our public consultations at the end of November of last year. And really, if everything was pushed and threaded the needle, the government was basically there prior to the Christmas vacation for all of like 2 weeks. We may have been able to get it done at the end of 23, but it didn't come in 23. It didn't. Then everybody has to come back after a slow Christmas in January. January became February. February became March. March became April. April became May. And then finally became in June. So we're actually operating in a very similar situation to what we did in 2023, in that in Q2, we were actually mining 5 working faces right in the middle of the meat of the ore, but we didn't have access to do all the pre-development work for the other areas outside of our bulk sample permit. So we're permitted to do that now. I would view Q3 as kind of the catch-up exercise to do all that pre-strip that needed to happen to access the rest of the ore. And then over the course of the last 8 days, we've been in the high-grade part of the ore zone. So Q3 is definitely going to be a step down from where we were in Q2. And then Q4, we're basically going to be back to where we were before. So I always caution people, San Albino specifically is not a widget factory. We try to make it as stable as possible. The decisions that caused this volatility was rational. It was when our balance sheet was tight in 2022 in response to an exogenous event that wasn't expected. And then decisions have repercussions, and the bifurcation of that permit did have repercussions in 2023 and 2024 as well. But it really has nothing to do with operations in general at all. Additionally, in terms of some of the volatility, we have some of our ore body goes parallel to topography, so it goes along with topography, and sometimes it goes perpendicular, or so effectively the stuff that goes parallel to the ore body, you're able to kind of dig out a much larger dip potential on those pits, make them deeper. The stuff that goes orthogonal, you have like relatively small open pits, and then really you have to approach the rest of that from an underground scenario, which also takes time to engineer and permit. And we're getting a lot more serious about the underground now than we were and have been in the past for those reasons.
Yes. So you answered for Q2, you answered for Q3 and Q4 in terms of expectations. But I think let's talk about, from San Albino's point of view first, what you want 2025 to look like for the asset. Because I feel like 2025 should be the year when it goes more towards becoming a widget factory, although it is not that currently. But that would be the idealized situation, that it really is extremely stable. Although it is a particularly tricky asset, to my understanding, to get to that point. It is not a simple open pit that you might have somewhere else, where you just truck ore into a big mill and then it's happy days. But it is a beautiful asset with a lot of potential, the exploration side as well. So what kind of key activities do you hope to carry out in 25 to get it to a more stable state?
San Albino will never be a widget factory. I think, like, even just from forget about geology, forget about it. Just think about intro to statistics class, right? So when you're dealing with super high grade ore bodies, you're really operating on the right tail of the distribution of what God put on this great earth. So anytime that you're dealing with the right end of the spectrum, you just have a lot more volatility in your data points, and that most deposits, that actually comes from just grade distributions. We actually happen to have pretty stable grade distributions, but there's always going to be some volatility and some differences just when you're operating on these kind of outlier types of deposits. Now, in terms of like being able to have enough material in front of us, enough working faces, enough flexibility to move from here or there, that I agree with you. So there's a few approaches to doing this. One is to make sure that we aren't permit constrained anymore. So we obviously have always been fully permitted on San Albino since 2017. We've been fully permitted over at Las Conchitas really only since early July, right, of this year, right? So we were operating for a period of about let's call it a year with an official bulk sample permit, and then an additional 6 months of this kind of hybrid approach, where the government gave us some dispensation to do some mining even without a bulk sample permit to begin with. So we've been operating in this kind of like weird permitting situation really only for up until about 3 months ago. So now we actually have some room to go over at Las Conchitas. And then once the pre-development is fully done on the 5 areas that we're mining right now, you'll have the ability to go from one mine to the other. Like a good example is what happened in the last 48 hours. So if we're at the southwest pit, we move over to Mango and El Limon and so on, and Bayakun and so on and so forth. So having that kind of flexibility with room to run, which is actually something ironically we didn't have in Q2. So even though Q2 was blowout numbers, we actually were constrained in where we can actually mine that quarter. It just happened to have been we were constrained in good parts of the mine, and then likewise when you're dealing with open pit and when you're dealing with underground going from open pit. There are things that take more time, right? You do need to engineer it. You do need to drill it out. You do need to make sure that you kind of have like a good understanding about where these pockets of high grade ore and consistency are. But one of the things that you actually don't need is you actually own the land now. So from a permitting perspective, at least in terms of how you operate under the constraints of Nicaragua, it's actually pretty easy to go and start up in a small scale underground operation. So adding those additional layers and degrees of flexibility are always going to be helpful. So if you have 5 areas of flexibility from an open pit, and then you add 1, 2, 3, maybe even eventually 4 different small scale underground portals over here, you'll always have the ability to move around when things need to be developed, need to be worked on, need to be exploited, so on and so forth. So all of those things are definitely helpful in terms of smoothing out the operations. Yeah, no question about that.
So it sounds like now you would expect that there should be no volatility next year or going forward from the permitting. The permitting question
right.
should be fairly addressed. At least that source.
right. This is mining. There'll always be volatility, and sometimes volatility is good, right? So sometimes we have somewhat unexpected positive outcomes, like what happened in China last night. So we're in the business of volatility. But you're right. At the end of the day, is that there's a lot of things that we control when we own the lands that we didn't necessarily control before, even though we didn't really think that there was a long-term constraint for us getting to the point that we are right now. There's a lot of things that it's now under, we have the ability to control our own destiny a little bit more than we did even 3 or 4 months ago.
Okay, so that's very good. And then the second order, I mean, it's all about having multiple mining phases that can effectively mine simultaneously, or that's the game. But a precursor to that is to be able to actually define ore bodies, because you're mining separate strains in a district, right? Separate ore bodies that require a lot of drilling to get the grade control right and so on. So, and that's the discussion we focused quite a lot of time with Frank on last time, and we'll chat with him again shortly here about this too. But would you say that the drilling side of things is not the constraint, or do you have to ramp up the total meters or the capital spend to really get to that point, or is it mainly, I mean, what is the true constraint? Is it getting more effective drilling done to be able to open several new more mine phases, or is it getting the underground operational and getting the skill set in there and kind of condition to be able to mine effectively? What is the true most important thing to be able to get to that point, you think?
Yeah, I mean, it's all of them. I would say our lives would be easier, and it would be easier to engineer the various types and areas of mining if we had a longer mineable resource in front of us. So I think if there's going to be like the top of the pyramid element of importance, it's that. I do think and we can talk about the philosophical approach in a second, but I do think that one of the things that we've experienced over the last year is that urgency is often taken over importance in terms of kind of where we were focused on drilling. So we put out our updated resource in November of last year. And then even in part of that needed to be infilled. So in order for us to make sure that we had like the proper planning associated with it, to make sure that probably the most important thing is just to make sure that we had the final like pit designs to make sure that we weren't actually screwing up any long-term infrastructure, and making sure that we had the ability to go and access some of the deeper parts of those pits without making any like major capex mistakes on developing those mines. So a lot of that infill for the first, let's call it half of this, a lot of that drilling for the first half of the year was focused on infill, when everybody, geologists, me, even our mining engineers were kind of understood that the real importance is do the step outs, make sure that you actually expand your resource over Las Conchitas, and probably more importantly is to actually go outside the areas that we know. So even in areas that we don't have permits in, but to actually start looking for other sources of initially open pit feed and eventually underground there too. So if you look at our overall drilling campaign from inception, so really from 2009, there's only been before what's today? Today's Thursday. So before Monday of this week, there's only been 12 holes that have been put outside San Albino and Las Conchitas ever. And that was a 1,000-meter program that we did at the end of 22 or the middle of 22, really just as a show me exercise to people that were criticizing our lack of resource. We said, look, we can make a discovery on demand. So we did a 1,000-meter program, 20 kilometers away from the mine, and lo and behold, we made a high-grade discovery over there. But that really was not there to develop a resource and then use that as potential mine feed. That's now changed. So as of Monday of this week, we actually put our first, I guess we're on hole 3 now. We put our first 2 complete holes outside of Las Conchitas and San Albino in the El Golfo area. This is to the south of the historic El Golfo mine. And for those that actually know the history of San Albino, is that back from inception, so in the early part of the 20th century, the second most prolific part of the ore body was not Las Conchitas. It was El Golfo. That was the second operation that was running contemporaneous and a little bit before the operations of San Albino in the 1920s. The only reason why that wasn't the second priority for the company, Mako and its predecessor, was just that the asking price for some of those surface rights, again going back to permitting and access over here, was higher than what we actually could get for Las Conchitas. Not unreasonably so, just because Las Conchitas was less well known than El Golfo. But now we have the ability. Gold prices have actually changed. People's expectations have changed. Now we're actually on the El Golfo property. We've put in 2 holes. It's not difficult to imagine that this is going to be a third mining operation based on the data that we have today, even without actually having any of the data back from those drill holes yet.
So, for example, to get El Golfo into that state, what kind of say that you are able to within, say, the next 3 months to get fairly confident? Yes, you have an open pittable thing here, and it could be a third sort of little camp in a district to start. How long does it take for you to get an exploitation permit, essentially an EIA and everything, to be able to get to that state, you think? Because you've gone through the gauntlet now with the government.
Right. I think that's kind of like a good caveat, right? So we've now gone through what I actually don't think people may have thought. Well, they can think what they want. That the bifurcation of the permits was a means to get the permits earlier. I actually don't think that's necessarily true. I think the bifurcation of the permits were really there just to save capital, and I think both of them actually took the same time from beginning to end in terms of acquisition of the surface rights, doing all the engineering work to submit to the government, the public consultations. The approval process, any things that we need to answer as part of them. Both of them took, I think, exactly 12 months from start to finish in terms of getting everything complete. Once we actually had a pretty decent understanding as to whether or not these were going to be mines, we obviously in both circumstances thought it was going to take 8 months and not 12. So could it happen a little bit earlier? Sure, I suppose. But I think the right expectation should be 12 months from inception.
And when would something like this potentially be initiated for El Golfo?
So we finished hole 2. Looks good, but you got to give these things some time. That being said, obviously we'd much rather have like this very large scale ore body. But one of the advantages of having relatively small scale open pits is that it doesn't actually take a lot of drilling to make a determination about whether there's going to be a pit there to mine. So I don't think the drilling program actually needs to be more than 10 or 15,000 meters really in any given location before we can make the real go no go decision about whether these things are going to be operational or not. And that, from a drilling perspective, is really something that we can, because our approach right now is to go and block off our initial resources with our RC drill program. That has been a game changer. That was a very risky decision that was made in 22, also to save capital. That has now, I think, proven out. So we definitely do need to have some core drilling for underground geotechnical work, occasionally for some infill work, just to make sure that we have a sense check on real grades and real lithological controls. But actually, to get like the bones of the deposit, RC works great. So that's something. And the importance over there is that in addition to being probably about 45% less per meter, it also, you wind up drilling probably about 2.5 times as fast. So in terms of cost and efficiency, it's night and day. So we're getting the same data running an $8.5 million a year a drill and broader exploration campaign, and we were running at our peak exploration with 7 core rigs back in Q3 22 when we were doing this at about a $15.5 million run rate.
It sounds to me like, I mean, if El Golfo keeps on giving, it could be sort of a late Q1 thing where you potentially decide to initiate a process to acquire permits. So it would probably be a scenario where it might start producing early 26 or mid 26 if it plays out.
Yeah, it could. Like all of these. I think like even the stuff that's 20 kilometers away from our mine over at San Luis. We wanted to and actually wanted to focus in that area. We actually bought some land and surface rights just to make sure that we had our toehold in that area. If we actually wanted to mine that and focus on an exploration program, we think we can wind up getting from raw discovery into production in our mine. Doing something within a 2-year time frame is doable for us. That's why it always played with people's minds a little bit. And this goes back to the philosophy over here, is that when we turned into a mine, it was almost like people forgot about our exploration property and potential. And they made a mistake in twofold. Like one, the fact that we actually had a mine instantaneously revalued all our exploration ground. That's because if you're going to be valuing something on an in situ ounce basis over here, you're kind of like missing the forest through the trees, because we can actually turn that into cash flow in a very, very short period of time. And the other thing is temporal in nature, right? So if you have the actual ability to turn a new discovery into cash within a 2-year time frame, is that the discount rate that you apply to those things, or the discount factor that you apply to those things, almost invariably has to be smaller than most of the other exploration assets that some of your viewers and listeners are used to. It changes everything in terms about valuation for the project. And this goes back from a philosophical perspective. I understand why mid-tier and large-scale mining companies really want to have, I want a 10-year mine life, so I know how to plan this out, and it makes my job easier. I won't get fired by the board, and so I get those decision processes. And there are types of deposits where that actually makes a lot of sense, right? There are types of deposits that really would only work at scale, and you want to be like comfortable about making those decisions when you're talking about capex numbers, like some of those projects. San Albino has never been like that. San Albino is, all right, you have like a fairly well-contained, relatively small capital investment that can easily be paid back with kind of what you know in the area, which we have in droves, right? And then you use the cash flow coming from that's going to be in reinvesting in the rest of the property that not only has been revalued because we have the infrastructure that's in place right now, but has also been revalued because we have the ability to compress the time of turning that exploration ground into cash.
But to wrap up the segment before we talk about Eagle Mountain, just to give a sense, remind everyone, what do you think, and we're not going to speak about specific quarters, but what would be your average, or what would be your hope in terms of full year expectations for next year? And you have been running consistently at 600 tons per day, so throughput is being obviously done great. It's just a grade that's varying, right? But if we look at the next year, what would you like to see for Mako? You said this is a pretty good year. We've done well.
Yeah, like so Q2 we wound up selling 12,500 ounces, maybe just under that. So it was running this at almost a 50,000 ounce a year clip. That's not what 600 tons a day would be for this project. This is at 600 tons a day at the types of real grade expectations. You should expect this to be a low 40,000 ounce a year producer. So running this at 43,000 ounces is kind of like where we want to be. And in doing that, I think there's going to be quarters that are going to be 12 and a half, and there's going to be quarters that are going to be less than that run rate. But on average, it's going to kind of come in at those kind of levels.
Mid-40s, and then in terms of an average stable cost structure, it's a smaller mining operation, so smaller items can vary on quarter and impact all-in sustaining costs. But the stable all-in sustaining cost profile for next year, what do you think is reasonable?
Yeah, exactly. So there's a lot of sausage at the factory that people don't see getting made, right? So a lot of the reason, from a unit cost perspective in terms of consumables, we really actually haven't seen any volatility. So like oil prices are down, but Nicaragua subsidizes oil a little bit, so you don't really see like major volatility one way or the other in that. Most of our consumables have been pretty flat, so unit costs are actually pretty stable. Some of the major decisions that we've made kind of that also stabilized costs is that there were key like pieces of property that allowed us to lower the haulage distances for waste storage, which was a big deal. Like if we weren't able to accomplish that, I mean, we were staring in the barrels for millions and millions of dollars a year of added expense to do that. So those are kind of like high risk, high reward type things that we need to deal with. And luckily we were able to kind of manage this well. I think about how many like balls were in the air from 2022 to the end of 23 in terms of land acquisitions, that we didn't have all the land for our permit. We were still negotiating things that were very, very important to us for some of these OPEX issues for waste storage and things of the sort. We were able to accomplish that. So I get it goes back to that philosophy that I was talking about, is like, I'm a board of a $5 billion mid-tier mining company. I want to make sure that this 10-year project is good. All the risks are taken care of, and I want to invest and underwrite on that basis. I get that approach. That's not us. We make capital decisions. We are good underwriters of risk, and there certainly was a lot of risk associated with Mako that I think we've managed in a very, very prudent and obviously in retrospect successful fashion.
I agree, and I mean, it's just kind of textbook comp of the life cycle of any organism or organization. It shifts over time, and you are in the growing phase, and maybe in 3 to 5 years from now you will have the same mentality that you speak of that.
Right, exactly. I guarantee you, like in 10 years ago, a couple of things are going to happen. Is like, this is going to be a company that will have 10-year mine lives with all the risks taken care of, all the boxes checked, run by somebody that's not me, right? So I'm the risk taker, and I'm sure there's going to be a lot of like pencil checkers as well that I think will do a much better job than myself when we are in that life a part of our life cycle, if you will.
Yeah. So I guess I just wanted a kind of a final answer for that, for all of the people that think a bit more simply than you do, I guess, about the business, that have multiple investments. You say mid-40s is sort of a baseline expectation. Yes, everyone understands it's not going to be completely straight each quarter. It's going to be a bit higher one and a bit lower in the other. And same thing for costs. But what cost profile would you expect? Say a 45,000 ounce. I mean, what will be the cash generation per ounce in your expectation for next year?
Yeah, I mean, even like, so, I mean, it's interesting the way that AIC is calculated. So like, even going back to that 2023 example. So I think we like reported, I want to say it was in the mid 1300s for an AIC when we had that weak quarter in Q3, and then Q4 we reported just under 1,000 or thereabouts. Yeah. Some of the oddities about how you actually calculate AIC is that the real cost, if you're actually looking at this from an actual like investor's perspective, I thought our Q3 costs were higher than what, like, reality versus kind of World Gold Council approach was higher in that Q3 and actually lower in that Q4. So when things are going well, they are really going well. And if anything, we overstate kind of what our costs are, like the case over in Q2. So our like real cash flow margins where, I mean, at least from a cost perspective, I think we reported just over 1,000. I think the reality is that our actual cash marginal cost was even higher than that at gold prices, about $500 lower than where they are right now. I think but again, Q2, I
and
think
just to crystallize here, so,
yeah,
so
yeah.
in Q2, I think you averaged 2,300 or something like this, or a bit lower, 2,250 or something like
Yeah, I
that.
think that's right. Like high 2200s was our realized cost, and then we reported,
Yeah.
I think, just over 1,000 on cost. But the actual marginal cost of operation was even lower than that. And then obviously Q3 is going to be substantially higher. Obviously, with the come down, we were focused on the pre-development work. But I think on average, when you're talking about this mines, when all that kind of gets averaged out in the wash, if you will, you're looking at an operation that really should be generating like AISC in the $1,100 or $1,200 range. And at these gold prices, I mean, we crossed. We're nearly a $2,700 spot right now. So this is a pretty extraordinary cash flow beast when all the mining phases are available to us. And then you throw in this project. Is like the timing of that acquisition could not have been timed better. Not all of that timing was intentional. So certainly got lucky on the timing on when we acquired it. But really, as soon as we acquired Gold Source, a few things happened. Is that Guyana became a lot more topical because companies that are bigger than us started to acquire other assets within the country. There are some very large scale operations, or at least operators in the country, and it's become topical just because of the geopolitical situation around the globe from mining perspective. Is that you can see that the majors and the mid tiers are laser focused on the Guianan Shield at this point as a next stage mining jurisdiction. And then also we had gold prices go up $800 since we were in the heat of the discussions with Gold Source as well. So all those things, you couldn't have asked for better timing on this asset. We published an NPV at 1850 gold on the asset at just under US $300 million. So you can imagine at these gold prices, margins have more than doubled. So you can kind of do a back of the envelope calculation on what the NPV will do of that project. And the amount of capital that we issued to go and acquire this, it's actually, I think, from a percent perspective, one of the most accretive acquisitions I've ever seen done in the mining space.
Yeah, and I guess we'll see in not too many years actually that play out. But for next year for Eagle Mountain, what are the key milestones you want to get through, and what are the approximate timings for next year?
Yeah, so 2025 is all about permitting. So there's three things that we need to get done. One is an off the shelf type agreement, which is the mineral agreement. That's basically determining the economics of the project. The government has elections in November of next year, and they basically said don't expect any changes to the economics, especially in the middle of an election campaign. So that's one where the negotiation with the government is a take it or leave it, right? So that to me is kind of like a pro forma type situation with the government. But we do want to kind of dovetail that into the two more important ones, which is the changeover of our prospecting license. And prospecting licenses are given on a 5-year renewable basis. Our prospecting license was due to expire next month, but then it got informally approved a month ago, and it got officially approved about 5 days ago. So that will need to change over to a mining license. And as part of that, we're also going to need to submit our environmental impact assessment to go and build the project. There are things that we do need to do internally. Probably the two key elements of, and there's a broader amount of data that flows into that, are the hydrology and the tailings, geotechnical work that we need to do for tailing storage and waste storage, and then the actual pit design. So I guess like three key elements over there, but all associated with all of those pieces of data that we need to work on. We started our hydrological drilling work about 2 weeks ago. So that's ongoing. We've done quite a bit of our baseline studies from an environmental perspective. The fact that it's been on hold for a while, we're going to get restarted on that. The expectation is that we're going to be applying for that change to the mining license in early Q3 and simultaneous basically put in our application or thereabouts for the EIA around the same time. I think G Mining actually is part of their update on the PEA for Oko, put out a little data point that they expect to have their permits given 6 months after the EIA is submitted. I think that's a reasonable time frame, but frankly, they know better than me at this point. Again, we've only owned this asset for about 3 months. And even though the G Mining folks have owned it for less, they've actually been involved with Oko for a lot longer than that. So I leave it to them to kind of publicly dictate timelines on that. But I don't think it's unreasonable to have the expectation that this will be fully permitted in the beginning of 26, in which case we can actually get this into production by early 2027.
And again, would you expect any design revisions to materialize once you potentially consider pit design revisions or something like this? Could you see?
I think we're like, yeah. Yeah, no, I think we're pretty like good with layouts and things like that. I don't really expect to see any like major surprises on the hydrological front or even on the geotechnical side of things. The big area is that I think is going to dictate a lot about, let's call it sustainable capital timing, is when that transition from the saprolite to the hard rock is.
Sure. And
I think that is going to be primarily determined based on the parameters of the tailings. The last thing you want to do is have like a saprolite only tailings storage and then stack hard rock on top of that in a country where it rains 3 meters a year, right? So that's like it's not even a permitting issue. That's on us. There's been like too many issues in the mining space with tailings mismanagement. We're not taking those types of risks. So I think the approach for us is that we're going to have like a saprolite only tailings area and then like the mix area for everybody else. And then we're going to see what is from an engineering constraint perspective, sensible to maximize the former versus the latter. So in the PEA, it was a 4.5-year approach. Could that be 3? Yes. Could that be 5, 6? Maybe, depending on if we find more saprolite only material. But those are going to be the real decision points that we make. That doesn't really have that much of an impact on annual throughput rate or anything like that. So this will still be a 60 to 65,000 ounce a year producer when all is said and done. But that will determine the timing of that sustaining capital, and that's probably not even going to be like an economic decision. That's going to be an engineering decision on the back of those tailings.
Yeah. Okay. And then very briefly, what do you think is the approximate spend on Eagle Mountain prior to getting into or to get to construction readiness? So say about a year or a year and a quarter of spend prior to getting to the financing stage. Do you have a sense of the figures?
Yeah, so I mean, normally I don't put too much stock into companies like PAs or frankly even most economic studies. It seems like the mining industry are focused on these reports, and there's always an understanding is that the outcomes are so different than the reports, but that's just the way that business is done. I mean, to me, I always think that bad data is worse than no data. That being said, the groups that actually went in to support Gold Source in doing that PEA were actually very credible. It was obviously very well engineered. It was done at the right time, right? So this was put out in January, so well after the inflation spike actually happened. So I think they actually had like a really good first line guesstimate for how much this is going to cost, which is like $96 million was the upfront phase 1 capex on this. I think our gut is that we can actually do it for less. So one of the big advantages that Mako has is that we do have our in-house engineering, procurement, and construction management firm, actually very similar setup to G Mining. And I mean, think about it. At the end of the day, they're still like a mid-tier. I wouldn't call them a major yet, but they're set up with a really, really well-designed engineering firm to go and build these projects. And we are the same way for a much smaller type company, both in terms of market cap and the types of projects that we're looking at. So Guyana is actually very fortunate to have companies like ourselves there developing these types of projects, which you really only find this type of expertise in the in some of the mid tiers and then the major mining companies as well. But in doing that, to have advantages, there are ways of designing these projects, both internally and even some external opportunities that have the ability to lower the capex on this thing. But those are the things that will also get sorted out over the course of the next, let's call it 9 months.
Yeah, sure. So what I'm asking, it's good that you refresh that for people, but what I'm asking is the spend for next year, essentially. So what is being allocated to the project?
Yeah, I think we're still finalizing budgets for 2025, but I think for Guyana, you're probably looking at something that will be in the neighborhood of around 6 million, I think. And again, that's going to be the hydrological drilling, that geotechnical work that will probably be teamed up a little bit with infill work. So it's not going to be really like drilling to find more, but it's going to be drilling that's really designed for engineering purposes that also might have some splashy drills that come out with it. And then doing all the environmental like baseline work to make sure that we're ready to go and submit that EIA by Q3.
Okay, that's very good. And then kind of to finish on a more broad discussion, I guess, just your capital allocation strategy. I mean, you guys are eager to grow, and I think you've made one of the more savvy acquisitions that I've seen in the industry this year. Fair to say. And I think obviously you guys should not you should do that again if you see the opportunity. So what are you looking at specifically? Because now you have to fit it into having both San Albino and Eagle Mountain, and Eagle Mountain is being fast tracked in Guyana. You have to fast track in Guyana. So what type of opportunities would fit into this profile? Put it that way. If you find something that would be equally or somewhat equally attractive as Eagle.
Yeah, so it's good that Mako is backed by a financial backer like Wexford. So it gives us the resources to be focused on development stage projects like Eagle Mountain. That being said, there's a limit, both in terms of capacity and desire, from a Wexford to go and do a lot of these or much bigger ones in nature. So you're not going to be looking at something that can be internally funded by Mako. That we're going to be looking at projects that will have multi-$100 million capex in front of it, especially in our current framework. Where I don't think we've actually had a demonstrable success in being able to attract that kind of quantum of capital from outside sources, right? So we've had middling success, I think, on attracting capital from outside sources. Hopefully that will change over time because we want multiple sources of capital. So I think given those constraints, it's going to be difficult for us to either look for larger scale development projects simultaneous and potentially even other development stage projects simultaneous to this. We're not obtuse, so we look for anything that makes sense, is that we think has value, and that can be all the way from the exploration side to the producing side. But it's going to have to be like a special opportunity if we're going to have like another development stage asset that's going to be developed at the same time as Eagle Mountain. So I do think that if we're going to be making other acquisitions, which we are working at now, it will probably be kind of like on that barbell. It's like things that are either producing or near producing, i.e. like jumping the queue in terms of the development timeline. And by the way, Eagle Mountain is a pretty short-term timeline. We're expecting to be constructing this thing within a year and a half. So either jumping that queue or potentially even on the other end, is that if there's like really attractive exploration assets that for whatever reason we have a better view on than the market, we would certainly evaluate those as well if the price tag is attractive enough.
Right, and I would assume in a situation where it will be something that's extremely near cash flow, it will be a brownfields thing, maybe a restart, something that might have for whatever reason not worked with the prior management. It might have been idle for a few years, something like this.
Yeah, it could be a mine. Like I mentioned this at the time of the acquisition on Gold Source, is that I actually thought the actual deal wasn't there to fix all of our problems over at Mako, but it actually did help us on one thing, which is it was very difficult for us to interact with other mining companies that didn't have any institutional knowledge of what Mako was about. The only thing that they heard about us was that they read on a blog or whatnot. So it was very difficult for us to actually have like a direct interaction with some of these companies, given some of the constraints of San Albino, which is the inability to provide a large scale resource. So unless you actually dedicated geological time to find out what the property is about, it was difficult to interact with those companies. One of the advantages of acquiring an asset like Eagle Mountain with the 1.8 million in situ resource that it has. And one of the aspects of having a project in Guyana is that it allows us to interact with some of those mining companies in a different way than what was the case before. Also, I think the fact that the gold market has really taken off, but gold equities are really only starting to now. The fact that there's kind of that dislocation made these conversations easier. So our pipeline for dealing with some of those companies have greatly improved. So I wouldn't discount us taking a look at a mine right now, something that's actually cash flowing, which is something that I thought was nearly impossible for us to do as the first deal. So this deal is almost like a little bit of a bank shot for some of the things that we're looking at today.
I think when you say that, some might get concerned, I guess, because I think many investors do appreciate the value creation you can have when you really leverage the unique situation you have with Jesse's team. But I would assume the style is that you won't be competing with too many people, because most competitors will not try to buy maybe a 50 to 100 or below 100,000 ounce mine that might be slightly dysfunctional in some regard or have some kind of issue with it that maybe you could easily resolve with the competency that sits within Jesse's team and broad-based competency as well in South America specifically, and also in North America. Would that be a fair characterization of some of the top ideas potentially on the right side of the barbell, more advanced in cash flowing stage?
You actually made two important points there that they're somewhat contradictory, but both important. So the first one is about whether there would be like some disappointment about us acquiring a producing asset versus a development asset. So one of the things, so I started in the mining industry without any experience back in other than being able to read Excel sheets and financial statements. So without any background in mining, I started in 2006, and the first like 6 months on the job, I was like, why would anybody invest in a mine when you just read these reports and all these reports show that they're cheaper than what's actually in production? This is silly. Just invest in the development projects. And people patted me on the head saying, all right, you good that you recognize that, knowing that it was all bullshit, right? So it's like the stuff that's on paper was just like they just were kind of overstating kind of what their cash flows are going to be, understating what their capex was going to be. In reality, it was the mines that were actually cheaper than development projects almost invariably. And then if you take a step back and kind of look at this as someone with at a 60,000 foot level and with decades of experience now, you kind of realize that almost by definition the mines are going to be better, because geologically speaking, you're going to probably want to develop the better stuff first. So the stuff that's actually in operation, like obviously there are going to be exceptions with discoveries over there, but you're kind of self-selecting for things that are better than what's out there that's undeveloped right now. So for any investor that's going to be disappointed, mines which are cash flowing are more valuable than development projects that are not, right? Cash flow today is better than cash flow tomorrow. I understand that zero interest rates kind of played with people's minds, but it's always been true. But the other point about lack of competition is that a good deal can be made bad by paying too high of a price. So I do think that in terms of what people are looking at, are these like 100,000 ounce plus type producers and projects out there. So it's not going to be where we're going to be competing, because I don't think we're going to add much value or to be able to attract. So I do think kind of in that subset, so that category of where you are in that range. I don't think we have a hard and fast rule of 50 to 100, but directionally I think that's correct. Looking at things that there probably aren't going to be that many competitors for, I think is kind of where our skill set and objectives are going to be focused on.
Very interesting. And in terms of jurisdictions, you want to stick within the time zone where Jesse's team has experience. Yeah. North America, South America is this.
Yeah, for us as the ones who are running the company, yes. I would never discount, like, if there's a guy based in Australia that really wants Mako, great. I think that would be a wonderful pickup, but it's not something that we can manage based on our current structure. That may change over time, but our current human resources infrastructure will be nearly impossible for us to focus outside the Americas at this point.
Okay, excellent. And in terms of share buybacks, you have been doing them throughout this year selectively. What's your going forward thinking around share buybacks? How does it fit into the strategy here?
Yeah, I mean, we have a lot of capital to deploy over Eagle Mountain. Like, our share buyback really was never about a capital return policy. We have an affiliated royalty company, Sailfish, where effectively it doesn't have any needs for its capital outside of acquisition. So it basically returns 100% of its cash flow to shareholders through dividends and buybacks. That's a policy. Mako is not. That being said, there was a situation where we had overhang on the stock in the middle of us having discussions about M&A, and it became very difficult for us to run our business with that. So we did use the buyback when we were in cash flow to deal with that. And then likewise, when we announced the Gold Source transaction, because we were limited in terms of what we can do in terms of direct acquisition of equity in Gold Source, we knew, just because we do have intelligence, in terms of understanding who shareholders are and what their intent is, even without having discussions with them, we were pretty certain that there were going to be some shareholders that were going to be upset with the Gold Source deal, and we wanted to be prepared that we dealt with them in a prudent fashion that wouldn't cause harm to either Gold Source or Mako. So we used the buyback as a tactical opportunity to go and lubricate the actual M&A deal. And two things happened. One, we were completely correct about shareholders without any conversation with me, about any understanding about what our long-term vision are. The shareholders blew out those shares on the second day of trading, and we were there along with other supportive shareholders, actually in the region that you represent as well. We're there to take a lot of that overhang out. And then secondly, we were able to help lubricate the deal. So we had 99% support for the transaction, and I think it left a good taste in people's mouths. But it was not there from a capital allocation or capital return policy. We would much rather redeploy our capital into exploration in Nicaragua, and then eventually the development of Eagle Mountain, just because the returns that you get on both of them, especially at these gold prices, are so much higher than you can get for the distributed capital than would be coming out of Mako, that it would be foolish not to.
Yeah, but so it's not a strategy, it's a tactic. But to my ears, if you don't make another acquisition next year, you will fall. I mean, the equity requirement to build Eagle Mountain, which is gonna have to be faced in Q1 or Q2 26, you will have far exceeded that in terms of cash buildup. I would expect, at least before then. So there will be excess cash to deploy somewhere, even with that in mind.
Yeah, absolutely. So Eagle Mountain will need to be financed. We're not going to generate enough cash from San Albino to go and build Eagle Mountain, even from unless you really want to be aggressive about how you finance it, which I suppose the higher gold prices go, the more aggressive you can potentially get. But barring any like crazy things from a capital structure perspective, there's going to need to be a finance in some form to go and build that. That being said, being in cash flow does two things. One, it's exactly what you said, is that there's going to be a cash allocation not only to get the project ready, but also a cash allocation to put in a pretty substantial equity contribution to the project as well. And then secondly, it also makes your life easier when it comes to raising external capital, whether it's on the equity, debt, or other side. It's just is. So yes, that's going to be helpful. In terms of other opportunities, I'm of the mind is that we now have a success over at San Albino. I think now most people even our critics who were looking at us, understood that the Gold Source was a good transaction. If we're still not able to attract like other institutional capital on the third deal, Well, then there's like a little head scratch moment. All right, well, what are we doing wrong? And maybe we're going to need to pivot over there. But I'm kind of confident that I think we now have enough of a track record that I think we'll be able to attract funds that if we wanted to do the third thing, we could do the third thing, and then it'll make our lives easier to do the fourth, fifth, and sixth thing down the line. So a virtuous. Not everything in mining is a vicious cycle. Sometimes they can be virtuous as well. People sometimes forget it. They're starting to remember it now that gold's at 2,700. But these things tend to build on themselves in both directions. When things go bad, they go really bad. But when things go good, they can go really, really good.
Yes, but I mean, if phase one is sort of 100 million or potentially even less, as we've discussed now, then I would hope at least that you would be able to take at least 50% debt, but potentially even more, which means that the equity portion is sort of 30 to 50 million US. And I don't think it's unreasonable to assume that could be the equity portion. I mean, that there won't be a raise to cover for that. I think it's a fairly significant permutation is that it's funded by cash, the equity portion.
Yeah, I mean, like obviously, there's a lot of moving parts in that. There's the assumption that the 96 is correct. There's assumption that it's a 50-50 debt equity component. There's an assumption that because remember, this is like a compressed time schedule. We're going to have that capital available by the beginning of 26, right? And assuming that everything kind of goes into line, there's not going to be $50 million of free cash flow. Like gold prices are helping out. There may be, but certainly from our budgetary perspective, there wasn't like actual free cash because there actually are like growth opportunities in Nicaragua that were focused as well. So even in that circumstance, there still would have, with those assumptions, there still would be like an equity contribution, which may not come from equity, it may come from something that's not equity or debt. But at the same time, even in that situation, even in that back of the envelope situation, it still means that Eagle Mountain does need to be financed in a certain respect. It just means that the actual hurdle is not that high for those reasons that you pointed out.
Yeah, very true, very true. I think that's a good place to wrap up now. So thank you very much. I guess we'll check in again, probably not before year end, but certainly early next year, I would expect.